All right, well, this is the Cow Guy Close, and I am Scott Shelley, also known as the Cow Guy. Thank you very much for joining us. And I think yesterday's market action made it official. Inflation is out of control, and the Fed can't do anything about it. I know they are well-versed in the causes and effects, but we keep sending them to perform economic surgery with a mallet and a butter knife. I mean, newsflash, folks, interest rate hikes ain't just going to cut it, okay? The market seemed to wake up to this after the surprise charge Target took yesterday. The CEO reported a stunning 52% drop in profits for Q1 as a cost increase with freight and inventory costs surged. Tuesday, rival Walmart badly missed Wall Street's expectations as well. So Mr. Market asked if it can happen to Walmart and Target, where else could it happen? And down the market went. Freight, inventory, and our old friend supply chain are all back to rule the roost. Folks, there is no easy fix. There is no soft landing. There will be some pain and some unintended consequences, but we will get through it. And for his invaluable view, we've drafted Mike Lee in for some help. Mike, we're going to get through it, but there's going to be a little bit of pain.
Yeah, Scott, we were just talking in the break. Throughout COVID, there was a tremendous amount of economic pain, but there was very little financial market pain. And at some point, those two need to reconcile with each other, especially with the inflation that we're seeing right now. Remember, the stock market is not the economy, and the economy is not the stock market. They are very much intertwined and interlinked. I think the financial pain that's coming from the Fed is going to be worse than, say, the economic pain. But I would reckon to say that I don't know if we're at a bottom. We're probably within 5 to 10%. But what's going to be different over the last few years is there's not going to be a snapback, because the next thing that's coming is the balance sheet runoff. And so the Fed has acquired a $9 trillion balance sheet, and they are going to let, starting June 1st, $45 billion roll off, or they're just outright sell. And then in September, they're going to double it. And I imagine they'll go to next September before they reconsider any of that. And if you think about it from a long-term standpoint, like there are more than 2 jobs available for everyone out there who's filing unemployment. And yes, inflation is out of control. And yes, there are lots of problems with the economy, but industrial production came out with a fantastic number earlier this week, a good retail sales number. So this is not an economy that's cratering like 2008. And if we go into a -1, -1.5% GDP for 2 to 4 quarters versus the Fed actually having ammunition to tackle our next COVID or 2008 or whatever crisis may come, I'd say that's beneficial to see your stock portfolio go down 20 or 30% from all-time highs.
Well, I mean, there's so many things. Yeah, I agree with you. And the reason why we're not going to have a snapback is because what you said. I like that about the balance sheet runoff, but I'm not quite sure that our viewers are going to know exactly what that means. So I'm going to try to say it as simply as I can, and I want you to correct me where I'm wrong. But you know, the Fed's been buying bonds, putting them on their balance sheet to keep bond prices artificially high. And when we have bond prices high, folks, that means we keep interest rates low, all right? And so at some point in time, these bonds have to either expire because they have durations to them, or they sell them. But either way, they stop being a bond buyer, they start being a bond seller, and that means the bonds go down in price and interest rates go up. So when they try to make their balance sheet less heavy or getting rid of some of the stuff that they've got on it, they in turn are going to be pushing up interest rates. Is that as simple as I can make it?
Yeah, and how that affects Wall Street is every time the federal government how that affects the stock market is every time the federal government needs to sell debt, they go to what's called a primary dealer. Your Morgan Stanley, your Goldman Sachs, these big banks. And what makes you a primary dealer means if there aren't enough buyers, you need to hold on to what's left and what's not sold at the auction. Well, now the Fed has been buying a very outsized portion of that for several years now. They're going to be a net seller, not a net buyer, which means all the big banks and a lot of the risk pools of capital on Wall Street are just going to have less money to invest in risk assets. So if JP Morgan sells more bonds than it owns, it's got a lot of extra cash. It's got to go find and buy more bonds. Yes, pushing interest rates down, but also giving them a lot of shelf space, a lot of inventory to go out there and buy stocks and other things that are going to return more than U.S. government bonds. And so with this overhang, this overhead supply, so if you're a commodity manufacturer, it's like all of a sudden somebody was just, so say the U.S. Strategic Petroleum Oil Reserve was out there buying 50% of everything, and then now they're going to be a net seller. Well, that's going to have a massive impact on the price of oil. Perfect. It's going to have a massive impact on the price of bonds, and it's going to take up a lot of shelf space that could be used for things like the stock market. So it's just, we have a limited upside for right now. I don't think we have that big of a downside because, a lot of these major companies that drive the indices are still making a lot of money.
Right, that's true. And I like to also what you said about the snapback. I think that's very key because if the economy does what I think you and I both think it's going to do, we could see a situation where we do have a shallow year-long recession. But coming out of it, as the Fed lets their balance sheet peel off, you might just see stocks not do a lot for 5 or 8 years. You know what I mean?
Yeah, and so the history of the stock market, when you look at a price to earnings multiple, so it's how many times does your stock trade the amount that you earn? So if you earn $1 a share, does your stock trade at $10 or does it trade at $50? So do you have a 10 price to earnings multiple or a 50 price to earnings multiple? Well, the historical average is 15. And if you look at that historical curve, you're either way above it for a very long period of time, which we have since 2015, 2016, or you're way below it, which is where we were from, say, 2006, 2007, all the way up to 2014, 2015. So we could be heading to that period where we're at like a 16 now, and now stocks trade at 12 to 13 times earnings because interest rates are much higher. In the long run for investors putting money to work, that's actually very beneficial. That means you're going to you'll benefit 5 years or 10 years from now when we have that multiple expansion. For people that own stocks now, that can be painful. But if you own the best companies making a ton of money, and Microsoft, if you're buying into that now,
right,
you're probably going to be doing pretty well over the next decade.
And that's lastly, before we go real quick, I'm going to say that I think you'd agree with me. When a car goes on sale or when jeans go on sale or when a shirt goes on sale, we're all too willing to rush out and buy it. But for some reason, when stocks go on sale, a lot of people they get cold feet and they don't want to do it. But this is the time because they're on sale. You're not going to pick the bottom because only one person does. But it's time to start thinking about maybe what I'm going to be adding to my portfolio, because if I do have a 5-year time horizon, this will look probably pretty good in 5 years' time.
Yeah, absolutely. High quality companies are high quality companies. And
That's
so,
exactly right.
Walmart and Target have just gotten absolutely destroyed over the last few days, and they're a large part of what's called the consumer staples sector. It's the XLP.
Right.
Look, that's a defensive sector. You're going to see a lot of buying into that over the next year as this economy slows or we do enter a recession. Target's trading at 11 times earnings.
Right.
I mean, that's unbelievable. Like, everybody loves Target.
It's on sale.
So, yes, they have. Everybody has, everybody's having problems and everyone stumbles. Well, that company's now become extraordinarily cheap. So, look, there's some opportunity out there. And so hopefully, I don't think it's going to be smooth sailing ahead, but I don't think we're going to have a lot of days like yesterday unless the market rallies 5% and then we give it back.
Awesome stuff, Mike. Thank you very much. We got to jump. Michael Lee, thank you very much, coming to us from Sarasota, Florida. All right, let's take a look at those equity markets real quick here.